Good morning, everybody. This is Kathy Neifeld with AgencyONE, and we are so happy that you have decided to join us for this call to discuss LifeMark Reinsurance Company. And if you've been invited to this call, you are either an existing shareholder of LifeMark Re, or you now, for the first time, have an opportunity to purchase shares in LifeMark Re as a result of your association and the production that you have done with AgencyONE. Joining me on this call is Gonzalo Garcia, my partner. Everyone knows Gonzalo. And we are thrilled to have Bill Shelow with us. Bill is the CEO of LifeMark Re, and Bill is also, Bill, I don't know your real title for Libra, but Bill runs Libra. So he's either the chairman, the CEO. He's the CEO of Libra, which, as I hope most of you know, is AgencyONE's back office. We are part of an IMO, and Libra is the organization that we're a part of that has put together this reinsurance company called LifeMark Re. So I'm going to turn this now over to Bill. He's going to give an overview. He also has a speaker that he's invited from the reinsurance company for LifeMark Re. Thank you, Gonzalo. And we'll turn it over to Bill. So, and this is being recorded. And also, if you've got any questions, we will take them. And if you have any questions afterwards, you can please reach out to me, myself, or Gonzalo. And if we have to get Bill involved, we will do that as well. So Bill, thank you very much for making yourself available, and take it away.
Well, thank you, Kathy. Thank you, Gonzalo. Thank you, Lisa, for hosting this and having us have this opportunity this morning. Good morning, everybody. We're going to talk a little bit about LifeMark Reinsurance Company results today. But just to kind of back up a little bit, just to give you the history of LifeMark Re, we decided to form LifeMark Re. Actually, I think we started the discussions back in 2016, and with Hanover Life Reinsurance Company. So we have a very strong and long partnership with the Hanover Life Reinsurance Company, and what started out as discussion around how could we as a marketing organization potentially share in the mortality experience of some of the business that we produce. And that's how the whole discussion started, and it morphed into us at the time forming a reinsurance company to partner with Hanover and then work with some of our key carriers to seed business so that we could participate in that mortality experience. And what we did was we went to the state of Delaware and we formed what is known as an agent-owned captive. So we are a captive reinsurance company. We are 100% owned by either our brokerage general agency partners in Libra or the producers like you that some of our partners have made this special offer to participate in the program. Other than that, there's no other outside ownership in the reinsurance company. So that's the way we're structured. And as I said, we have an important relationship with Hanover in this structure. And the reason for that, obviously, is when we're working with our carriers, and as you know, we have actually 4 companies in the program right now. But as we started off, and Prudential was the main company, there was really no way that a major life insurance company was going to cede reinsurance business to a small agent-owned, non-rated captive that, at the time had about $3 million of capital in. So, the structure that we've worked out is that, the carrier, the direct carrier, in this case, Prudential is who we started with, Prudential would cede business to Hanover, and then we would capitalize LifeMark Re and then we buy the reinsurance from Hanover as a retrocessionaire. So Prudential carves out the Libra business, cedes it to Hanover. We take our capital, and we buy as much of that business as our capital will allow us to buy at any given point in time. And of course, the structure is Hanover will always have 50% of the mortality exposure that Prudential, in this case, gives them. And then we're eligible to buy up to that other 50%, depending on what our capital level is at any given point in time. And the reason for that is obvious that, Hanover is, they're doing all the pricing, they're holding the reserves, they're paying the claims. And so they're really kind of administering the program really in exchange for 50% of the business. And so that's the way the organization is structured right now today. So I'm hoping that Jason is on.
Hey, Bill, can you hear me?
Yeah, now I can, Jason. Thank you.
For some reason, I'm not getting my video to. We had this problem last time, so I apologize for that. So you may have to do without my video.
Okay. So let me
unless I can figure it out as we're going along.
That's okay. Let me introduce to everybody Jason Rickard. Jason is the Senior Vice President and Head of Life Solutions for Hanover. And he is our point person in this entire structure and has done a wonderful job of working with us. And we have been able to add more companies to our program. We're in discussion with other companies. And what is really awesome about this is if you look at the entire program right now today, we have over 24 billion of face amount in our structure today. So Jason, I'm going to turn it over to you.
Thanks, Bill. Appreciate the time and good to talk to everybody. Sorry that my video is not coming through, but I can at least see Bill and Gonzalo and a few others on the screen. So good to see everybody, and I won't take too much of the time today. Just really, as much as anything, wanted to echo a lot of what Bill already went through as far as the partnership. For us, this is a really key partnership. We've many of our management team has known Bill for a long time, and I guess when this was first put into place, now several years ago, it's hard to believe how much time has passed. I guess about 5 years now, Bill, since we first started talking about this, and I guess really 3 years of putting the business now into the program. It's just been a real success, I think, on all around, and so we're thrilled to be expanding it. As Bill said, we've got several different carriers. We're talking to 2 more this year to add into the program. And I think in our industry, when you can find a win-win, really a win-win-win situation like this, where where the producing company, the producer itself, the people that are out selling these products, and the reinsurance company can all sort of come together to find a very effective program. I think that's pretty rare, and so really all credit goes to Bill for putting this together, and we're, like I say, we're thrilled to be a part of it. As Bill said, we've got now, hard to believe, over $24 billion worth of life insurance that has gone into this program over that time period. So it's growing very quickly. The changes that we made in, I guess it was at the beginning of this year, allowed for the partners in the program, in the LifeMark Re program, so the Libra partners to increase their shares, largely because really what we did with the program is to allow for the business that gets seeded on the back end of Hanover assuming the business from the carrier companies, and then retro seeding that into the LifeMark Re program. That was really based on kind of the ability for the kind of the retained earnings that are in the program to grow in a way where it could sort of fully capitalize the amount of statutory reserves and capital that were required by the regulators. What we did earlier this year was we reduced that capital requirement by effectively changing that from being a statutory requirement to being a GAAP requirement. For those that know anything about that accounting, it's basically it significantly reduced the capital requirement that LifeMark Re needed to put up on that. So what that meant was that the partners increased the amount of business that that came through the program. So we were excited about that. One thing maybe that to get into a little bit about the industry itself that I know Bill and I have talked a lot about, and I think it's important, is that in 2020 we all know that COVID was sort of the big topic for everybody, and certainly for Hanover it was a big topic, and it still is into 2021. And in fact, we saw some of the largest claims in terms of kind of COVID claims in the early part of this year. So at the peak for Hanover itself, we were paying over 200 COVID claims per week. And so for us, obviously that put a lot of strain on our financials, but I think it also underscored for us what we do as a reinsurer and in support of all of your clients. Is that's what we do, is we pay claims, and we partner with our with the companies that we reinsure. So in the program, Prudential, Nationwide, Symetra, John Hancock, this is what we're here for. So as much as it was sort of an earnings event for all of us, including LifeMark Re, this is exactly what you all do, is you provide financial security to your clients, and we're a proud partner in doing that. What we hope is that as we work our way through COVID, that things will subside, and certainly we're starting to see that a little bit, or at least had seen that in basically May through July. COVID claims had gone from that peak of over 200 claims per week to now they're less than 50 per week. Now that the Delta variant has made things a little bit more complicated for all of us, as we all know, and we're starting to see a little bit of an uptick in that. But what we're hoping is that a lot of the things that we all learned through the COVID crisis in 2020, that will help us and sort of prepare us to moderate anything that's happening with the Delta variant. So again, kind of a very challenging 2020 and early 2021, but we hope that we're sort of turning the corner on this, and there's a lot of sort of tailwinds for the program going into this. And I think some of the things that will help kind of grow out of those losses that we saw over the past, say, 12 to 15 months are, again, as we alluded to, the value proposition with the preferred partners that I mentioned before: Prudential, Nationwide, Symetra, Hancock, and again in discussions with a couple others as well. The volume that will be increased as part of the program, and as part of that quota share increase with the restructure that we did at the beginning of 2021. We're expecting improved experience, as I mentioned before, and I think the one thing that Bill and I have been really focused on over the past, really a couple of quarters here, and we're going to talk about this at the board meeting coming up here in another week and a half, is going to be really the monitoring of the experience and working with our partners as a value add to look at the claims experience and just see where we can help our partners in terms of underwriting changes, in terms of claims management changes, and things of that nature, so that we can improve the experience as much as possible. And so I think all those things will help make this program operate as expected, if not better than expected. I guess, Bill, those were some of the framing comments I wanted. Was there anything else that you wanted me to sort of cover for the group?
No, Jason, I think that's great. And, it's a great backdrop to, kind of the 2020 results that we're going to share. and what we anticipate here for 2021. So thank you. We appreciate it.
Hey, Bill, this is
Yeah.
Gonzalo. But before we let Jason go, there is a question from one of the attendees. Jason, thank you for your comments. The question is, what has been the weekly claim pace pre-COVID if it has varied between 50 and 200 claims per week during COVID? I'm not sure if that's clear, but I think I understand what the question is.
Yeah, I think maybe I wasn't as clear with my comments. The 200, and then maybe if I don't answer this, we can try it again. But the 200 was the excess deaths related to COVID. So that was at the peak, and now those excess deaths. So above what we would just normally see with non-COVID claims, it was 200 additional claims that we were paying per week in just COVID claims. So last year, just Hanover alone, and I know this is going to be a little bit, maybe the context would help on this, but last year alone, Hanover, just for our share, paid $200 million worth of just COVID claims. So those would have been above and beyond the claims that we would expect to pay, that aren't COVID related. So Gonzalo, I don't know if
across Hanover, right?
That was across Hanover. That was
all
not
of Hanover, not LifeMark Re. Got it.
That was not LifeMark Re. Yeah, right.
Got it.
So I just putting it into context that for us, it was not what we would call a capital event. And and when I say a capital event, sort of reducing our capital, but it was certainly an earnings event. And the program itself, Gonzalo, the LifeMark Re program, likewise has been able to increase the funds withheld account, really the capital account that they have, largely because there's been additional capital contributions through 2020. So there was, that COVID did provide, kind of a bit of a stress on the capital account. But going into 2021, we expect for that to reverse and for the capital account to continue to increase. And for those that don't know how that works, basically as that capital account increases, that will increase the amount of the quota share amount that gets seeded from Hanover into the program. So additional opportunities for future profits on the business.
That's great. And the person who asked the question, Ralph, thank you for that. Says thank you. That clarifies the issue. So
okay,
thank
great.
you, Jason.
No problem. Thank you.
Gonzalo, are there other questions? I see the number increased a little bit.
No, that was Kathy saying thank you, Ralph.
Oh, okay.
you can proceed. You can proceed. I'll go ahead and monitor the questions as they come in. Thank you, Bill.
All right, appreciate that. Hey, Jason, thank you very much.
No problem, Bill. Always
All right.
happy to participate. So
All right,
thanks everybody.
you. We'll talk soon.
Thank you, Jason.
Okay, bye-bye.
Bye-bye. All right, so let me go ahead and take you through the 2020 results. And as Jason said, it was a tough claims year for our LifeMark Re. But just to kind of look at the overall financial picture, you can see that in 2020 we had 24.5 billion face amount, and that's up 9%. Now some of these other numbers that you're going to see, they kind of change because of quota share and results, and I'll go through that in a second. But that 9%, that kind of shows you what the real growth of the program was 2020 over 2019. So we were able to actually grow the gross face amount by 9% in the year, which is really good because we are consistently coming off a pretty high base right there of 21 billion. So I think that's a good number, and we like the trajectory of the growth of LifeMark Re. When we put this thing together, we had kind of anticipated a 10% growth rate. So to come in at 9% in 2020, which was a pandemic year, I think was a pretty strong performance for the organization.
Hey, Bill, can I jump in there for just 1 second, just kind of as a point of clarification? In reinsurance, clearly face amount is kind of the driver, right? But in terms of diversification of risk, the number of policies is also very important because you spread that risk a lot over a lot more lives, right? So You may have some concentration risk issues, and I'm sure you're going to talk about it on the claims conversation, because I'm obviously familiar with what happened with that large claim. But the more lives we have, the more carriers we have involved, the more policies that we're writing, you continue to spread that risk over a broader base of insured. So while face amount growth is important, we also have a pretty big growth in number of lives that we're covering. Is that a fair assessment here?
Yeah, that's a very fair assessment. And I didn't put those numbers up here, but we are over 95,000 policies in the reinsurance program right now. And I expect that this year will exceed 100,000 policies. And so, we're, as Gonzalo said, the diversification, the growth is really important. The diversification of risk is important. Getting other carriers in the program is important, because, it's a kind of an underwriting variation. The product mix is important. So when we put Symetra and Nationwide in, that's only for permanent business. Pru is predominantly term business. So it's moving, everything's moving in the right direction with respect to the growth of LifeMark Re right now. Okay, so if you can see our premium number, and one of the things that I think is really important, and Gonzalo mentioned reinsurance premium, so to speak, is when we sell a term insurance policy that costs $1,000, it doesn't really relate at all to the reinsurance premium we get, because reinsurance, all of our reinsurance is on a YRT, a yearly renewable term quota share. So, $1,000 level premium for, 20 years, that may work out to, on a YRT basis, maybe we're getting, $175 in the first year. And then, that increases every year to where, when you have that crossover point, it's more than $1,000. So that's the way the premium is structured. So when you look at the relationship between 24 billion of face amount and $3.6 million of premium for our share of that, you cannot relate it to the sales side of the premium. Okay, just to be clear. But you could see that number increased 67%, and that number increased 67% because part of it was at the beginning of 2020, our quota share was 13.6%. We ended 2020 at almost 20% quota share. So not only did our business increase, the percentage that LifeMark Re was able to buy because of our capital raises that we did in 2020 increased significantly too. So that's how the premium actually increased 67%. Now, our sales load, just so everyone is real clear, just for Prudential, we get a little sales load on top of the reinsurance premium. So it's a non-risk bearing small amount of excess premium that they pay to LifeMark Re in return for our commitment to continue to do term insurance business with Prudential. And, and again, it's on every single premium that comes in. So what you see here is, while our sales, let's say, increased 9%, the sales load increased 41 because we got that load on the first year premium. We get it on the second year premium plus the new premium. The third year premium, we get the second year and the first year again. So it's a compounding number. And so our sales load actually increased 41%. And just so everyone is real clear, we take that sales load and we make that part of our capital so that we increase our quota share. That's the way we fund some of our increased quota share. Claims and claims reserves. Here you see a very big number. You see the $4.9 million number in claims and claims reserves. And again, part of that was the adverse death claims that we had, but part of it also was the increased quota share that we had. So not only did we have increased claims, we went from having 13% of that allocated to us to 20% of that allocated to us. So, and we got hit with both high volume and high severity. And I'm going to kind of go through a claims analysis for you here so that you get a feel for that. So the net settlement to us last year, when we look at the Hanover kind of, financial distribution, it was concerned was, we had a negative $1,047,000 compared to last year when we had a positive $502,000 a year. So if I go to the next slide, just kind of talk a little bit about the claims review. So we had 144 claims in 2020. And obviously that was higher than was anticipated. You know, kind of on average, you expect a little over 1 death per 1,000, on average. So at 95,000 policies, we would have thought we'd have probably had somewhere in the 100 to 105 range as far as the number of claims was concerned. So we did have a higher than normal claims volume. And then you can see here, we also had 10 COVID claims in 2020. And the total death benefits that were paid from those COVID claims was $407,940. So it certainly did impact us. If we wouldn't have had those claims, that the number that we would have shown would have been a lot less than what we showed as far as the impact of that was concerned. The other thing is that when in 2020, we had our first, what I would refer to as a large loss impact. We had one claim that cost LifeMark Re $985,000. So that equated to 20.7% of our total claim cost was in one claim. And for those of you that would remember, for those of you that are new, one of the things that we built into our program very early on was we had an aggregate stop loss. And we buy that from Hanover, and in aggregate, we can never lose more than 20% of our capital in any given year. And so, as we looked, and when we started off the company, that seemed to be pretty solid protection for our organization. And we were happy with that. And, what has happened is as our capital has grown, obviously the exposure that we're now subject to has grown. So this particular claim happened to be a $10 million policy to Prudential, and was just a gentleman who was 52 years old. He was a business owner. So out of that 10 million, 5 million went to Hanover, and we ended up with 19.6% of that, which was $985,000. And unfortunately, that gentleman died in a boating accident. So it was not something that was driven by underwriting. It's just one of those things that, again, as Jason said, this is what we're in the business for. And, unfortunately, it does have a financial impact on our company. But again, nothing that we won't recover from. And one of the things that Gonzalo, Kathy, and I, and the whole organization, we continue to talk about is having a reinsurance company and being in this business is it's a long-term venture. Okay. We don't ever, measure our success or, have discussions around, oh, we had a bad year, what should we do? I mean, we have 95,000 policies in here, 24 billion of face amount. It's growing, it's continuing to grow. We firmly believe that long-term, just like every other reinsurance company out there, the long-term, this is going to be beneficial to the shareholders that own the organization.
Hey, Bill, if I can just make a quick comment on that. I mean, again, it's very hard to predict accidental death, certainly boating accident by a 52-year-old gentleman. And I think that goes to some of the integrity of the underwriting process that has been, adopted by the carriers that are partnering with us. I've always told, the advisors that are on the phone, it's like, look, if you're writing a Pru or a Nationwide or a Symetra policy and do our YRT pricing, because every year we get a little bit more retrocession or premium because of aging of clients. That all is just this moving train, just continues to get bigger and bigger. So, we got whacked with a big claim. we got to get over it, move on. And you'll see here, maybe there's a silver lining in that, on a going forward basis.
Yep, absolutely. Thanks, Gonzalo. And I just kind of give you a snapshot here. When you're an insurance company in the state, and we're filed in Delaware, we have to file our statutory results, and our statutory results are also the way we file our taxes and everything else. So you can see on a statutory basis, our premiums, went up from 2.5 million to 4 million in the year. Our net losses incurred, went to 4.9 million. So you can see, and again, we had some expenses associated with that. You will see on line 15, the other expenses, which is really the change in the statutory reserve. So our statutory reserve increased from 633,000 to 2.6 million. Largely, a lot of that due to the growth that we had in our capital. We doubled our capital last year. And because of that, the statutory reserve associated with our business really increased. And I'm going to go through with you in a second, but you heard Jason allude to kind of how we restructured our organization so that we can kind of reduce the impact of that statutory reserve and deploy more of our capital to the actual quota share itself. So you can see on a net income basis, on a statutory basis, we lost $3.6 million last year. This kind of shows the impact of the capital and surplus account. So you can see that we had 4.3 million of capital surplus at the beginning of the year. We take away our net income, but you can see again our paid-in capital, our new stock that we issued in 2020 was 4.3 million. So it gives you an idea of what that capital raise was, how that increased our capital base, and hence the result in the statutory reserve from that perspective. So just to kind of shift to the GAAP numbers now, obviously we measure everything, with respect to how we measure the organization, really on a GAAP basis. And, on a GAAP basis, I think most of you probably received the private placement memorandum to see if you're interested in either increasing or initially participating in ownership of LifeMark Re. And you'll see in there that I think our net income declined. We had a net loss of 1.8 million on a GAAP basis when you look at the GAAP statements that we put in the private placement memorandum. So our GAAP equity ended the year at 7.496 million, almost 7.5 million. So when you look at that on a projected share price, what does that mean for our share price? It means our share price is actually kind of at 94 cents a share. And again, when we issued and we capitalized the company, we capitalized it with a par value of $1. So we can never be less than $1 as far as the value of our stock to any particular shareholder. So I want everyone to be very clear on that. One of the things I want to talk about, I did talk about the sales load that Prudential pays us. And if you think about that sales load, that goes on every premium every year for the duration of every product. And so when we looked at just the sales load for 2018, 2019, and at half a year of 2020, we did kind of a present value calculation of that. Because believe me, Hanover would buy that cash flow stream from us in a heartbeat if we felt like selling it to them. And so that, when we really look at that, we say, okay, if we really looked at that as kind of an asset, because it really doesn't show up anywhere on our balance sheet, on our income statement, other than the annual sales load. But if you look at the present value of that, was somewhere in the neighborhood of $5.4 million on a present value basis. So if I added $5.4 million to the value of our company, if we could sell that tomorrow, our share price would be $1.58. So, and again, that increases every year. The new business that we wrote in 2020 gets that sales load. The business that we're writing in 2021 gets that sales load. So, I don't want anyone to look at this organization and not understand that there is some real future value just when you look at it long-term over the value of those sales loads. And even if Prudential said tomorrow, hey guys, we're done, we get that sales load on all that business for the next 20 or 30 years, depending on the duration of the product. That can't go away.
And Bill, just to put things in perspective, the volume that the Libra firms do with the advisors that are on the call is somewhere in the neighborhood of 100 million a year. So it's not an insignificant amount of production that we do collectively with Prudential.
That's right. That's right. So just wanted everyone to kind of see that, because I think it's an important thing as you factor in, hey, what's the long-term value of any investment that you put into the organization? So we did a couple of things at the beginning of 2021. And one of the first things we did was we did a scan of all the large cases that were in the, in the program. And we did find that while there's not a huge number, there are some cases in the structure that, Hanover may be holding, $15 million of exposure. And, so 20% of that for us would be $3 million. And so when we really kind of, and just so you guys know, we have our own consulting actuary firm, Lewis and Ellis. So, we audit everything that is done with Hanover and LifeMark Re. So we had Lewis and Ellis do an analysis of our risks. And we decided that it would be in our best interest to have a per person retention limit in the program. So the way we handled this was that Hanover can't put any more than can't put any more than $2 million of exposure in the program. So if they have a case that they're holding 5 million, like this last claim was, if they're holding 5 million, they can only put 2 million in the LifeMark Re program. And then whatever, so right now, our quota share is 20%. So the most we could take on any individual claim right now today is $400,000. So we did want to make sure that we could minimize, that maximum exposure that we had and that impacted us in 2020. So we took care of that. And then the other thing we did was we have a new structure in our program where we retrocede back to a division of Hanover. And what we end up doing is financing the statutory reserves in excess of the GAAP reserves. That increases the quota share. So at the end of the year, we had 19.66 without putting any additional capital in. At the end of the first quarter, in this new structure, we own 25.19%. So our quota share actually went up 5% just because we put this structure in place, which was exactly what we wanted to have happen. We still have a stop loss mechanism. It looks a little bit different than just a pure 20% stop loss. We basically create an experience refund account, and the claims run through the experience refund account, and it's capped in a way that our stop loss comes into play. And that's the way we've structured that. Lewis and Ellis, like I said, our consulting actuaries spent months modeling this with Hanover to get to the right number and the right funding amount for that experience refund account. And we feel very confident that this is a great structure for LifeMark Re going forward. Again, when you look at the end of the first quarter, and you're going to see this impact in our first quarter numbers, increasing quota share is great when you're making a profit. It's not so great when you're posting a loss. But our quota share went to 25.19 compared to 13.77 last year. So when you look at the first quarter numbers, you're going to see that our premium increased 137%, again, because our quota share went up. Our sales load stays the same no matter what. Okay, and again, you can see it's continuing to grow. Last year, it grew 41%. First quarter this year, it grew 42%. And that has no bearing on our quota share. And by the way, important to note, Hanover gets no access to our sales load. That is 100% non-risk bearing capital coming into LifeMark Re every year. Okay. So our claims and claims reserves in the first quarter went from in 2020 was 731,000, went to 2 million, an increase of 176%. Again, a big chunk of that because we doubled our quota share. So in the first quarter, we had a net settlement or net loss, if you will, of 439,000. Again, this mimicked very much Hanover's experience in the first quarter as well. So it wasn't really a surprise to us that we had some COVID carryover, if you will. And those of you that kind of track COVID, you'll remember that we had a huge countrywide spike in regular COVID claims in the month of January, and which obviously resulted in some adverse claims experience. So when I look at the first quarter, we had 46 claims, 7 of them were COVID claims. So 25% of our claims were COVID. Or 25% of our claims costs were COVID. And Jason already gave you the industry perspective, so I won't spend a lot of time reviewing that. So what else do we have going on in LifeMark Re? Well, one of the things I'll tell you is it's important for our carriers to commit to the program. And one of the things that we have been talking to Nationwide about is how does this become more important to them? How do we make them more important to us? And so we agreed on doing $10 million of business with Nationwide in the year 2021. When we looked at Nationwide, the reason we felt very confident in this, and by the way, our production through the first 4 months, we were annualizing to 9 million anyway. So this isn't a big leap, but it does put in concrete that we want to increase our focus with their company. When we looked at the company through the first quarter, Nationwide was ranked number 5 in first quarter life premium, number 5 in overall growth, growing at 66%. They're number 1 in IUL, number 4 in no lapse guarantee, and number 10 in VUL. So I think when we looked at the overall kind of profile, said there's no reason that, with the partners that we have, with the advisors that we have, that we can't look a little closer at Nationwide and increase our production there. So that's one of the things that we committed to kind of support our reinsurance company. The other thing we did, and you heard Jason mention this, effective in June of 2021, we added John Hancock to our structure. And what we added becomes pretty important to us. And again, Gonzalo talked about diversification. And so this was really important. And that is that we are taking only the John Hancock term business that's 3 million and up, which really means that we're focused on the fully underwritten term insurance business with John Hancock. We did an analysis of that business. We liked the mortality associated with that business. And it seemed like a great place for us to kind of carve out what we think will be a meaningful amount of business. And what they're seeding, they're taking 20% of every case 3 million and up, and they're giving it to Hanover. And then we're taking our share of that business. So that's the way the structure is. And we're thrilled to have Hancock in there. We looked at our growth rate right now with Hancock, and it's we're on a tremendous growth rate with them right now. So we're pleased that the reinsurance company gets to participate in this aspect of that business as well. So we are very bullish on what the future is. on what our opportunity is. And, you know, one of the things that, and I hope you folks understand this, it's a very small percentage of advisors in this country that get this opportunity to participate by having stock in a reinsurance company like this. And obviously, you know, AgencyONE is a very strong partner in Libra. Gonzalo is on our board of directors. They play a very prominent role, and they've understood the value of giving this opportunity to select advisors out there. And we think this is a really unique opportunity. Obviously, it comes with some responsibility. That responsibility is meeting the production requirements. There are production requirements to participate in this program as an advisor. And I think that's important, again, because the opportunity is done on a very, very select basis. When we look across the spectrum of all of our partners, there are not that many that get this opportunity. So, you know, you gotta meet that production requirement 2 out of 3 years. And I think it's a minimum of 100,000 of production that has to come to AgencyONE. And, you know, we don't really care what company it is. It doesn't have to be the companies that are in the reinsurance program. Obviously, you know, the more you support that, you get to participate in the experience of that business. But, you know, the important thing is to be that what we refer to as an elite advisor. I know that the AgencyONE has another name for their top advisors. And I just think that this is such a unique opportunity, such a strong partnership between Libra, AgencyONE, and you folks that isn't really replicated anywhere else in the country. So I'm thrilled to have this opportunity to talk with you about that. And we are doing a stock offering right now. The stock offering is at $1 a share. As I said, that can be the minimum, and the minimum share price. That stock offering expires August 30th. Okay, so keep in mind for you folks that are on the phone or on the call here, the minimum amount you can purchase is $2,500. The maximum amount you can purchase is $25,000. So that's the opportunity out there. And again, we only have until August 30th to get that completed. By the way, we do a stock offering every year. We're going to continue to raise capital. That's an important part of us getting from 25% ownership to get to that 50% ownership. That's our objective, is to maximize the financial opportunity of owning a reinsurance company in this structure. So that's what we're doing. And then, you know, and as we grow the production, you know, we need to grow our capital. Otherwise, our production increases. If our capital stays the same, our percentage of quota share just goes down, right? So in order to really get this thing up to that 50%, we need to continue to increase the capital of our organization. And by the way, we do that, you know, you heard me talk about the sales load, but also when we make profit, we automatically reinvest the profit into the organization to increase our quota share. So there's no distribution of capital right now in the reinsurance company. We have issued stock dividends in the past, but we're not doing cash dividends because, again, our focus, get to that 50%. That's what we want to do. So with that, I'll leave that up there. I'm going to let Kathy say a few words and then we'll take questions.
Thank you. Bill, that was great. Much appreciated. So a couple comments. And again, if anybody has any questions, please type them in and we will get to them. My first question, just for point of clarification, is we circulated documents in an email which said that the last day to participate was August 31st.
Oh, that's fine.
Okay, you know, it's the details that give me the stomach ache. So I just want to make sure that we're all on the same page regarding the end date for the offering.
I had no idea there was 31 days in August. So now we're good.
Every single year. Okay, fair enough. You had mentioned that this has been in existence for about 3 years, and the goal is to have a minimum of one offering a year, a maximum of one offering a year. This is going to be the only offering this year. Where are we in that regard?
That's a great question. In the past, we've done a couple of different things. For those of you that don't know, Libra is the result of the merger between Bramco and LifeMark. And so we wanted to give the Bramco agency principals an opportunity to participate, in the ownership as soon as the merger was completed. That was part of the merger deal, so to speak. So we did do 2 offerings last year, but we are going to just do 1 a year from this point on. And just so everyone knows the way we time that, we get our audited GAAP results come back. They have to be in by the end of June. We have to file them with the regulators by the end of June. But we normally get the GAAP numbers officially sometime in the month of June. And that's why once we get that, then we get the new values, the new stock value, just on a book value basis. And then we do the stock offering right after that. So that's why the timing is always July to August.
Thank you. You had also mentioned the minimum production requirements in order to remain a LifeMark Re shareholder. And
Yes.
They are $100,000 of commissionable first-year target premium per year in 2 out of 3 calendar years. And that's one of the reasons that AgencyONE, among others, produces a quarterly scorecard. So for those of you that are on the call, and for those of you that are going to be listening to the call afterwards, if you are an existing shareholder and you have not met that minimum $100,000 requirement in 2 out of 3 calendar years, we will be reaching out to you. There are a few people that are at risk of having their shares being called back by the company for not having met the requirements. So you've got between now and December 31st to make sure that your production hits that $100,000 target. And if you've got any questions, please feel free to reach out to myself or Gonzalo. Does anybody have any questions? I haven't seen anything come in.
I would just say one last thing, Kathy, and like anything else, you guys are astute financial advisors. Clearly, when there's a drop in a stock price of a company that, as you've heard, seems to be on a growth trajectory that's pretty impressive, COVID notwithstanding and a shock claim last year notwithstanding, I believe the price last year was $1.19 after the stock dividend. This is a 20% discount on something that certainly I believe is going to continue to grow and has a growth trajectory that's pretty impressive so far, certainly in the first 3 years. So, I have an equal opportunity to buy as you guys do. This is not a sales job, but this is an opportunity for you guys to participate, buy low now as the company continues to move forward. So I'll leave you guys with that thought. We do have a question, Kathy, from Ralph again. Thank you, Ralph. What are the consequences in subsequent years should we not hit the target? Bill, you want to take that, or Kathy? So I think that the more clearly is, what is the redemption process if you miss 2 years in a row of not hitting that 100,000 production level? And then what do things like retirement or disability or other things like that, kind of what are the triggers there, Bill?
Yeah, so let's just talk about if you miss the target. And I think it's important to recognize that, as Jason talked about at the very beginning, when we structured this and we talked about how to put this program together and how to include producers, again, the thrust of this is to be win-win-win for everybody. Okay. And, the way that, we win in working with you is through your production. I mean, that's incredibly important to us. And that's why we've structured it this way. But So what does happen is if you miss those and then we get the notification from AgencyONE, that you've missed those, then we start the process of purchasing back the shares that you bought. So that's, I mean, it's pretty simple. That's what happens. And it's at the lower of the current price or the price you bought it. So that's really what happens if you do that. Now, Gonzalo did ask a question, and we have made some changes on this. That if you actually retire, you're holding, let's just say you're holding, $100,000 worth of LifeMark Re stock, and you retire, you are able to continue to hold that stock, participate in any dividends, and continue to act like a regular shareholder. And the same thing is if you become disabled. Way back when, if you look at the original documents, that really wasn't structured that way. But Gonzalo actually was very instrumental in us changing this, because he said, wait a minute, I put the equity in to help you grow the company, and then I retire and you're going to take it away from me. And we said, you know what, that makes total sense. Why would we do that? And so now you are able to hold on to your stock, participate in dividends, and participate in any capital appreciation for the organization.
So, Bill, let me ask you a question. Thank you for that answer. If you buy in now at $1 a share, and subsequently you do not meet the minimum, and LifeMark Re goes to repurchase the money, really, the stock, really, have you only lost the potential growth on that money? Because if you buy in at $1 and you wind up you wouldn't purchase it back for anything less than $1. Where's the risk? Is that correct?
That's correct. Unless the value goes up and we're buying it at $1, then you lose that, right?
Right, exactly.
Yeah.
But it's not as if you've bought it at $1.50 and you're buying it back at $1.
Right.
Right. Okay. Ralph, I hope that answered your question. But we expect big things from you, Ralph. So I don't think this should be a concern. All right.
Wait, you're not limited to 100,000. Just so we're real clear on. Okay.
Thank you, Bill. Yeah, thank you. Okay, I don't think that we have any other questions. I would just encourage everyone to review the documents that were forwarded to you. If you've got any questions, please reach out to myself or to Gonzalo. If we cannot answer your questions, we will reach out to Bill, and he will get us the answers that we cannot provide. And, if you need help filling out the documents, what to sign, how to sign, let us know. And like I said, we're here to help you. I think the only thing that I would ask is that let's try to avoid that fire drill on August 27th and August 30th. Invariably, it happens every offering.
Yes.
But the earlier that we can get this in, the better. Just by way of process, you send all of the documents to the offices of LifeMark Re, and along with your checks, but they get held for a little bit of time while LifeMark Re looks at all of the documents and make sure, and they make sure that everything is in good order. So we have had folks reach out to us and say, I sent you a check and it's been a week and it hasn't been cashed. It doesn't happen that quickly. But so there is a little bit of a delay, but these deadlines are something that we hold near and dear to our heart. So please be mindful, and thank you for your time. And I hope everybody stays safe, has a great rest of the summer. Bill, thank you for your commitment and dedication, not only to Libra, to LifeMark Re, but more importantly to us, to AgencyONE. We appreciate all of your help with everything that you do.
We appreciate you. Thank you very much.
Gonzalo, would you like to make anything?
No, that's a great conclusion, Kathy. Thank you. And Bill, thank you as well. See you at the board meeting.
All right, sounds good. Thanks, everybody. Great being with you.
Wait. We have one more question. Sorry. From Ham Pointer, what is your target capital raise from principals and advisors every year?
Well, like I said, last year we were fortunate that we raised, between two stock offerings, we raised $4 million. Okay. So, that tells me that, kind of our kind of average run rate is about 2 million. And so, again, I think between the 2 million and I'm hoping that that we can really kind of look more closely at like 2.5 million, that plus profit. If we're putting in $3 to $3.5 million every year, we're going to have a chance to kind of continue to grow and get closer to that 50%. But that's kind of the target. And again, keep in mind that we are, again, agent owned. So it is a closed block of investors that have opportunity here, and we understand that. We have no intention of trying to deviate from the value for our partners and their advisors, and we're just going to continue along those lines.
Yeah, and Bill, just to put things in perspective, there are 60 partner firms at Libra. So firms like AgencyONE, there's 60 of them. Our life production is about $400 million a year with the variety of different companies. So all 60 of those firms and their principals, such as Kathy, myself, and Dennis, have the opportunity to buy in, as do a select group of advisors, such as yourselves on the call. So it's a very limited number of people that get to participate in this. And that, it's a $400 million beast that's feeding, LifeMark Re. So that's important as well. Okay. Any other questions? And we'll wrap. We'll call it a day.
All right. Well, thank you very much.
Thank you, Bill. Appreciate
See you soon.
everybody on the call. Take care, guys.
Bye-bye.
Ladies, thank you. Bye-bye.